Hey, what is up, my people? Want to talk about stock splits. That's the topic of the day. So a lot of people are getting very excited. I've heard a lot of news, a lot of chatter about stock splits that are happening, and big companies, Nvidia has had stock split recently. Apple's had them in the past. Other companies are having stock splits, and people are excited. And some of the chat groups I'm in and other places that I've talked to people, they're very excited about buying stocks because they're splitting. Well, I'm going to give a quick tidbit of information. A stock split pretty much means absolutely nothing. Now, let me tell you why I believe that, right? Because if the value of a company is $1 million, and let's say they had 10 shares outstanding, then each share is worth $100,000 because the company would split themselves in 10 ways. Well, if $1 million company splits themselves a million ways, every share is worth $1. So if you had one of those $100,000 shares and they split it, you're literally going to just have 100,000 of those shares instead of one. So it changes the number of shares that you have, but it doesn't change the value of those shares. They're still worth $1. Now, in my opinion, companies do stock splits to trick retail investors, because retail investors look at prices and they do price comparisons and look at things and say, ooh, that's my budget, I can afford it. Well, a quick tidbit is there are things now in brokerages. If you're not with a broker that's in the Stone Ages, they allow you to do something called fractional shares. And I use Robinhood, but there's many different brokers you can use out there. Any of them are usually pretty good, but fractional shares allow you to buy a piece of a share. So for example, Berkshire Hathaway is Warren Buffett's company, and Warren Buffett's company, one share of his company is worth, oh my gosh, like over $500,000, around that price point, right? So to buy one share of his company, you'd have to spend a whole lot of money. Well, guess what? Most people don't have $500,000. So if someone wants to invest in Berkshire Hathaway because they believe that Warren Buffett and his portfolio of companies is doing well to grow, they would have to buy a fractional share. So if they had $100,000 and his company's worth $500,000, they would have 1/5 of a share. Same thing if they had $5. They would get 0.00 blah 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 59247321, I don't know, something, but you'd have 0.00000 whatever you have of a share if you put $5 into buying a piece of Warren Buffett's company, Berkshire Hathaway. So the fractional shares allow you to purchase a company at no matter what price point it is. So I think a better indicator of who you want to purchase as far as companies isn't who is having a split going on, but it's who you believe has an applicable service or product that's in the market that has an opportunity to grow in the market, so that company can increase their revenue. Because a stock split does not mean that a company now has more value. It doesn't mean they sold more widgets. It doesn't mean they sold more services. It doesn't mean they made more profit. It doesn't mean they lowered their costs. It doesn't mean they acquired more property. It doesn't mean they won some big legal lawsuit and don't have to pay a class action to some large group of people. It means nothing about their bottom line. All it changes is the total number of shares available in the marketplace. Now, also when you're concerning dividends, because I always talk about cash flow investing because that's the way that I'm looking at investing. If a company or a fund splits, you receive a dividend in proportion to the split. So for example, if I had one share of a company that paid me $1 per share, and that company did a two-way split, that one share turns into two. So instead of receiving $1 for my next dividend, I'm going to get 50 cents. But in total, if they were paying $1 per share, I'm still going to receive the same dollar. It's just going to be split amongst the number of shares I have, 2 shares. If that company did a 1-to-5 split, then my $1 would come to me as 20 cents times my 5 shares. Because if they split 1 to 5, I have 5 shares. To pay me a total $1, I'm now going to get 20 cents per share. So it doesn't change the total value of what you have, and it also doesn't change the total value of what you receive in your dividends. So my opinion with people looking at splits and saying, oh, look, this company's splitting, I'm going to buy them before the split because instead of having 1 share, I'll have 10. Well, it's like, well, if you really believe in that company, you would have been buying their shares well before a split. And a split wouldn't have mattered to you because you know it doesn't change the value of what you purchased. But you do know this: human nature is another component of the market that people don't sometimes consider. And it's hard to factor in because the risk of human nature and how people will react is hard to predict. I mean, during COVID, toilet paper was the craze. And we couldn't really figure out why, because nobody had bubble guts from COVID. They had an upper respiratory infection, but for some reason, toilet paper was what people felt they needed, and we sold out of every piece of toilet paper that there was available in the local areas. So anyways, you can't predict human behavior. So when retail investors see the price point of a share of a company that they wanted or were looking at, and the price point goes from $500 down to $100 because of a 5-way split, they all of a sudden feel like they're getting a steal of a deal, and they buy more of those shares, which helps give more money to the company. Because if you buy more of the company shares, then you're helping the company get more money so they can invest and do their thing, more value. So in many instances, when companies do a split, they're betting on the retail investors' lack of knowledge and understanding of the market to increase purchases of their shares. So when someone sees that $100 share then go down to $20, they say, man, I can afford $20, but I couldn't afford one when it was at 100. And then people go ahead and buy a share. And if you multiply that by millions of people who don't know or are ignorant about how investing works, then they get duped into buying all these shares, and it does in total add more dollars invested to a company. But really, my opinion is it's a trick. If there's a company that you really believe in and their company's doing well, and you've done your due diligence or research, or you put your common sense together and say, hey, that's a company I want to be a part of, I want to buy some of their shares, then just go ahead and buy them. But don't worry about splits, because you're going to get paid the same amount, and you're also going to have the same value that you had before. Now, there are a couple instances where I've seen companies do stock splits to hide that they were lowering their dividend. That's another example that is a little more rare, but I have seen it. So that's using some funny math to trick people, because people that don't pay attention wouldn't know. So I had a company once, what was their name? I'll try to remember their name. I can't remember their name right now. If I remember it, I'll post another video. But I actually sold all their stuff because I don't like how they operate. But anyways, they had, let's say I had shares of the company, and they were paying me 10 cents per share. The company did a reverse stock split. So what happens with the reverse stock split is, if you have 10 shares, they may condense those 10 shares down to 1 share. So in essence, they're taking up away by 10 times the number of shares available in the market. So I had 10 shares, my 10 shares turned to 1 share. So if my 10 shares are worth $1 a piece, when it split down to 1, I all of a sudden have one $10 share. So it makes it look like, oh my gosh, I went from $1 to $10. Wow, that's great. But I had 10 shares, now I have 1 share. Well, cool. Now it looks like $10, so it looks like more money. And the dividend, let's say the dividend was 10 cents per share. So I received a dividend of $1 every cycle that they paid. Well, now that they split my 10 shares into 1, instead of getting 10 cents per share, I should get for that 1 share $1. Well, what the company decided to do was change their dividend payout from that total of $1 to, let's say, 80 cents. So really, they lowered the dividend by 20%, because I was getting paid in total $1 before. Now I'm getting paid 80 cents. And since they condensed the shares, I have 1 share for $10 that looks like it's more valuable, because it went from $1 to $10, which I should be receiving $1 for a dividend. But since they lowered their dividend looks like 80 cents. Well, if you look at the history of the company, the dividend would have looked like it was 10 cents before, and after the reverse split, it would then look like it was an 80-cent dividend. So some people that are looking at it but not doing the math of it would look at the company's history and say, oh my gosh, they used to pay 10 cents and now they're paying 80 cents? Wow, they're paying 8 times more than what they paid before. Because when you look at dividend history, it doesn't show price history. It only shows payout history. And if you don't take the time to look into the price history along with the payout history, you can't tell if what you're actually getting paid is more or less, unless you're calculating the yield from before and after. And sometimes people don't look at that or properly, see what's going on there. But anyways, that was one instance where someone did a trick. They condensed the shares to make the price look like it was higher, and then they paid a lower dividend. So hopefully that would trick some of the retail investors that don't pay attention to the actual total yield that they're receiving on their dividends. And some of it didn't show up right away because in the calculated math of it, yield is calculated over 12 months. So that 1 or 2 months of lower dividend yield didn't create a big difference in the factoring of the math of it. So either way, it was just a way to trick people. But for the most part, splits don't matter. Don't pay attention to them. Pay attention to how companies are operating. If they're operating well, buy them anyway. If they split, who cares? Keep doing what you're doing. Keep buying them because you believe in that company and you believe in their opportunity to grow and be successful in the marketplace. Video's getting long, so I'm gonna stop it there. Hope that helped give some insight, understanding some people, and I'll see you on the flip side.